Welcome back to the deep dive. Okay, so our sources today are presenting, well, frankly, a bit of a split personality. It's October 2nd, 2025. And the crypto market seems to be juggling two really different narratives right now.
Yeah, definitely.
On one side, you've got this incredible institutional optimism, like soaring higher than we've ever seen. But then right alongside that, there's this intense volatility, mostly driven by, short-term stuff. It kind of feels like watching a really mature, established company suddenly get strapped onto a highly speculative rocket.
That's actually a perfect way to put it. And, our mission today is really to give you the quick path to understanding that exact contradiction. Yeah. We need to synthesize what's genuinely driving this institutional gold rush. Why are the big banks suddenly so incredibly bullish?
Right.
And then we need to look at the key metrics, like the fear and greed index, which tells us where the market is right now, and connect those sort of short-term jitters to the bigger picture, the long-term tech and regulatory trends that are actually getting locked in by everything happening today.
And that high-impact signal, it's really loud and clear now. The biggest, most conservative players in global finance, they're finally giving digital assets this powerful, you really can't deny it, stamp of approval. But here's the challenge for you, listening in. How do we make sense of this new foundation of institutional stability when, at the same time, the market sentiment is screaming pure, unadulterated hype?
Okay, let's unpack this. We should start with that foundation, right? The institutional piece. Yeah, let's start with the really solid proof that the market is, actually growing up. The biggest news, I think, in our stack is the CME Group. They're getting ready to launch 2047 crypto futures trading starting early 2026. That feels huge. But why specifically 2047? Why does that signal maturity?
Well, what's really key here is it boils down to risk management for these massive global firms. In traditional markets, things mostly shut down overnight, right? But crypto, it never sleeps. So by offering 2047 futures, the CME is basically removing that geographic risk, the time zone risk that big institutions face, managing their books across Asia, Europe, the US. So they can always hedge, always adjust.
Exactly. It makes the market safe enough, you could say, for those really deep institutional pockets, because they can manage their liquidity, their exposure, literally nonstop. It's like the fundamental financial plumbing getting a serious upgrade.
Okay, that makes sense. And that acceptance, that safety, it translates into valuation numbers that are, they're pretty wild. We're seeing serious, very specific forecasts from major banks. JP Morgan, for instance, they've put out a $165,000 target for Bitcoin. And Citigroup, even more bullish. They're talking a range, $181,000 to $231,000. Wait a sec, those numbers are just astronomical. Are these banks just like throwing out aspirational figures, or is there something concrete behind this, even short term?
That's the crucial question, isn't it? And no, they aren't just throwing darts at a board. When a big bank like Citi or JP Morgan publishes a specific target, especially a range like that, they're actually modeling the potential economic function of these assets.
Economic function? Like what?
Well, they justify figures like $231,000 by modeling scenarios like, say, mass adoption into corporate treasuries, or even bigger, what percentage of global reserve currency, or even traditional securities like bonds, they expect to be tokenized and settling on blockchains within, say, the next 3 to 5 years.
Wow.
Yeah. So this modeling, it really shows they believe this big economic shift isn't just coming, it's already underway.
But it's not just price targets driving this shift, right? It's also regulatory. We've seen a really critical pivot there. The new SEC chair, Paul Atkins, he's actually made establishing a clear legal framework for digital assets a top priority. That feels like a complete 180 turn from past approaches. Seems like it reduces long-term risk significantly.
Absolutely. Capital just hates uncertainty, doesn't it?
Yeah.
And getting clear rules of the road, that's like oxygen for institutions. However, we do have this immediate pressure point creating some short-term anxiety, and that's the U.S. government shutdown.
Right, that's still ongoing.
Yeah, and it's currently stalling the approval process for new crypto ETFs and other really important regulatory decisions. It's kind of a perfect storm, really.
Yeah.
A clash between that long-term institutional belief and this immediate, messy political gridlock.
And even with that gridlock hanging over things, we're seeing corporate adoption pick up speed. It's not just the usual tech suspects either. We're seeing public companies like Metaplanet, Vivo Power, VisionSys. They're actually increasing crypto holdings in their corporate treasuries. What kinds of companies are these, and why now? What's the drive?
So these are often firms involved in things like energy, infrastructure, sometimes digital operations. And the motivation seems to be, twofold. First, it's a straightforward treasury management play. Using these decentralized assets maybe as an inflation hedge or just an alternative to holding piles of cash.
Makes sense.
Second, and maybe more strategically, it signals their longer-term plan. They might intend to eventually use these blockchain networks for actual business operations, trying to get ahead of the curve. So it's really a strategic vote of confidence in the technology itself.
Okay, so moving from that institutional belief to what's happening right now. Let's check the market's pulse. Price action, it's still positive. Bitcoin recently cleared, what was it, $119,000?
Yep, cleared 119K.
And Ethereum is actually showing even better performance lately. That got a boost from BitMine's recent billion-dollar investment, right?
That's certainly helped sentiment around ETH. Yeah, $1 billion is significant validation.
But the real story, I think, is the sentiment itself. What is the fear and greed index telling us right this minute?
Okay, so right now the index is sitting at 64. That puts us firmly in the greed category. But what's really crucial here is the speed of this move.
How fast?
It jumped from 49, which is neutral, just yesterday, and only last week it was down to 44, which is fear territory.
Wow, that's a huge jump, from 44 to 64 in a week. What does a reading of 64 in greed actually imply for, risk?
Yeah, it's incredibly fast. Think of a 64 like,
Right.
well, like being at a party where almost everyone is already feeling pretty confident, maybe overconfident, placing big bets. You sort of get the feeling a cool down is coming. You just don't know exactly when or why.
Okay.
So this high sentiment technically suggests the market might be due for a sharp correction, especially if it pushes up towards extreme greed territory. That's generally seen as above 75. It basically signifies potential market exhaustion. Most investors who are eager to buy might already be fully invested, leaving the market quite vulnerable to any kind of negative news trigger.
Vulnerable. Okay. But despite that psychological risk, that potential for a pullback, the institutional money just keeps flowing in, right?
Yeah.
The ETF data confirms that.
Relentlessly. Yeah, the ETF flow data is pretty astonishing. Bitcoin ETFs pulled in $676 million in just the last 24 hours.
$676 million in a day.
In a single day. And that brings the total inflow to over $4 billion in just the last 4 weeks.
$4 billion in 4 weeks. Can you, put that number in context? Is that normal? Is it unprecedented?
It's definitely not a normal month. It signals really sustained high-level demand entering the market. These flows are a huge positive indicator because they represent persistent, likely less speculative capital coming in day after day. This kind of steady inflow provides a sort of price floor that the purely retail speculative market often lacks.
Okay. We also need to touch on BTC Dominance. It's currently around 58.2%. Now, if Bitcoin's rising and institutions are clearly buying Bitcoin ETFs, what does it mean if that dominance number starts to drop?
Yeah, that's a really important indicator for market rotation. Typically, a rise in BTC dominance means capital is flowing towards the perceived safety of Bitcoin. However, if dominance starts to drop while Bitcoin's price is actually still increasing, that suggests capital is starting to rotate out of that relative safety.
Into
riskier assets.
Right.
Into altcoins. It's often seen as a potential early signal for the start of an altcoin season, where other coins start to significantly outperform Bitcoin.
And we're already seeing some sectors benefit, right? Not just the established coins like XRP, Litecoin, Solana.
Exactly. Those are moving, but institutional attention seems to be really zeroing in on some very specific foundational areas now. We're seeing a lot of focus on real-world assets, RWA, and also advanced stablecoins.
RWA, remind us quickly what that is.
Sure. RWA is basically tokenizing ownership of tangible off-chain assets. Think about putting a fraction of a commercial real estate building or maybe a corporate bond directly onto the blockchain.
Okay, got it.
That's the core idea behind initiatives we're seeing from platforms like Mantle and also World Liberty's WLFI RWA plans that were in the sources. This is where a lot of the, let's call it smart money, believes the next major wave of value creation is going to happen, bridging traditional assets with blockchain efficiency. And this focus on RWA brings us right back to that long-term trajectory we were talking about.
Yep.
While the short-term price swings are exciting, the real transformation hinges on regulatory clarity. The commitment we see from SEC Chair Atkins, plus the future potential of that Delayed Genius Act, especially its focus on stablecoins, well, that's fundamentally reducing the big systemic regulatory risk. That risk has been a major roadblock for deep financial integration for years.
Right. And the technology shift that's enabling this deep integration is tokenization and DeFi, decentralized finance. And here's where it gets really fascinating. There's that quote from Robinhood in our sources that tokenization will eat the entire financial system. Now, that's not some fringe crypto believer saying that. That's a major platform, millions of users, stating very clearly where they see the future of finance actually heading.
It's a powerful statement. And tokenization, to really work at scale, needs basically three things. It needs that regulatory certainty we just discussed, it needs massive scale, and it needs really efficient ways to transfer value. And that's exactly where stablecoins come into play.
Okay.
Their evolution, especially the ones backed by large, transparent, audited reserves, is increasingly seen as the essential backbone for global money transfers in this new system. They provide that instant, low-cost liquidity layer that makes buying and selling, say, a piece of tokenized real estate or a tokenized bond viable frictionlessly anywhere in the world.
And this whole infrastructure shift, it's being noticed globally, right? Not just in the US. Our sources mention news that more nations are actually considering establishing strategic cryptocurrency reserves.
Yeah, and that is potentially huge. If sovereign nations start officially allocating strategic funds, national reserves, to digital assets, well, that's pretty much the ultimate form of long-term validation. It signals non-speculative, potentially permanent demand entering the market. When you start seriously thinking about central banks diversifying their reserve portfolios using these assets, you realize the market is moving into a completely different league.
Okay, so we've got this undeniable institutional buy-in, this long-term optimism, but let's bring it back to the present. What are the immediate short-term risks that you, our listener, need to be really aware of right now, especially given that high greed index reading we talked about?
Right. Well, the primary risk scenario, I'd say, is a sharp, maybe unexpected volatility shock. The growth we're seeing is definitely driven by excitement, maybe even hype, but the market appears highly leveraged right now. That U.S. government shutdown, that remains an immediate wild card and uncertainty factor. And crucially, that current greed sentiment, sitting at 64, means any piece of negative macro news, maybe a bad inflation report or some geopolitical surprise, could potentially trigger a very rapid, perhaps disproportionately large correction.
Right, and we absolutely need to stress here, none of this is investment advice.
Definitely not.
But it is essential context for thinking about managing exposure. So beyond just watching the price ticker, what should you be focusing on?
Okay, so first, maintain awareness of those broader macro risks, things like geopolitical tensions, and especially central bank policy like what the Fed does with interest rates, still really dictate the overall flow for risk assets, including crypto.
Makes sense.
Second, diversification remains absolutely critical. Consider allocating not just to Bitcoin or ETH, but to areas with potentially strong fundamentals, like some of those RWA projects or major foundational blockchains. Don't just chase every hot meme coin. And perhaps most importantly, right now, you have got to resist FOMO, the fear of missing out.
Easier said than done when things are moving fast.
It really is.
Yeah.
But rely on your own research, your own analysis, especially when the crowd sentiment is this high, this convinced that the price can only go in one direction. That's often when risk is highest.
Okay, solid points. What are the absolute must-track events or data points for tomorrow, October 3rd, 2025?
All right, for tomorrow, first, keep a close eye on any updates regarding the government shutdown. Any news there could impact those regulatory timelines we discussed. Second, monitor any speeches from Fed officials or maybe ECB officials over in Europe. Any hint about monetary policy, especially a more hawkish turn, could really deflate market sentiment quickly.
Got it.
And finally, keep an eye on the derivative markets, specifically signals like high positive funding rates.
Okay, wait. Let's quickly clarify funding rates for listeners who might not be deep into futures trading. What exactly are they telling us?
Sure. So think of the funding rate basically as the cost of holding a leveraged long position in the crypto futures market. When that rate is highly positive, it means longs are paying a significant premium to shorts, essentially betting heavily on the price going up.
So lots of bullish leverage.
Exactly. High positive funding rates signal that the market is potentially dangerously over-leveraged to the upside. And that makes it highly vulnerable to a sharp, sudden liquidation cascade if prices were to drop even slightly. It's a key warning sign of hidden fragility in the market structure.
Fascinating. Okay, so bringing it all together as we wrap up this deep dive, what's the big picture takeaway?
I think the core takeaway is really about distinguishing between the long-term maturation story and the short-term speculative froth, the fundamental shift. It's happening. It's driven by serious institutional adoption, things like the CME validation, the moves towards regulatory clarity. So Your job, as someone trying to navigate this, is to focus on those long-term structural changes, the SEC's direction, RWA tokenization potentials, while maintaining, frankly, extreme vigilance over the short-term speculative excitement. And that excitement is clearly signaled right now by that rapidly rising fear and greed index sitting up there at 64.
That makes perfect sense. Separate the signal from the noise, basically. Okay, and here's a final thought for you to maybe chew on. We have these major, credible banks putting out optimistic, yet incredibly precise price targets: $165,000, $231,000. So the question is, what kind of massive new regulation or maybe a technological milestone, like, say, the full tokenization of major commercial debt markets, what would actually need to happen to confirm those kinds of figures? And maybe more importantly, how much of that potential future is already baked into the price now, given the current highly leveraged greed sentiment we're seeing? Something to think about. We'll leave you with that one. Thanks for joining us for the deep dive.